I'm going to send you my contact information right after our meeting, and that's all documents we will talk about in the voting. And give it out. Also, very commonly, we actually do pilot with our clients. We put a cost doing pilot, and what that entails is that we do by 50 or so of your
Okay.
cases.
Let's start.
So, yeah, we have to either talk to an action or talk to the data. So,
Starting now.
potentially, this would be a good way to sort out what it is.
You send it, Luis? Yeah, right.
I'm done. I'm all good.
Give it 30 seconds and then we go.
Yeah, there's a number of values. I can send you a number of references, for this values, as well as I'll talk about them.
All right. Good afternoon, everybody. Fabio Ronetti, Luis Carvalho, Jay Pelosky. Jay will talk, but before he talks, I have some notes from his August 30 meeting, Jay, in which you were dead right in many issues. One, as you know, Byron, we used to say, I'll give you half a right because you have to discuss, it's more like this high nominal worth growth, which I think is very important. I mean, and we're seeing that, but very few people are talking about that. I think high nominal worth growth was, which, as you say, will have a huge effect in EPS. And I remember after you talked, people like, Coca-Cola and Pepsi reporting 16% top line growth, and everybody was impressed. But then you say, well, if you have 8% inflation, maybe the 16% top line growth is a little bit different, right? But anyway, that was one of the things that, maybe it was less. But then you say something like the US dollar will go down, dead on. I mean, we've been talking about that in Winston, a lot about that. Number two, energy will go down, dead on. I mean, we had the OPEP, emergency meeting over this weekend. You were there. Euro financials, very interesting, 28 weeks of outflows, maybe less so there. But we want to hear about that because you always look into the financial sector. Let me look into that. Second half of the year, another great one is when inflation peak, the market bottoms. And I think that was clearly something that we saw happening around October, the 9%, 10%, and we had that. Another great call, China will exit the lockdowns. Big mistake by China, they will exit. We have those announcements. This is August 30, and the announcements came in January. So it's not like you were talking when they were happening. You talked before it happened, and you had that. The market is very fast. It's adjusting very quickly. We'll talk about that now that we have gone from fear of inflation now to fear of recession very, very quickly. So, all right, I'm not going to comment anymore, but you have serious.
No, keep going.
As I say, remember we said we need to take the credits because eventually we will be wrong, very wrong. And so basically, we remember the good ones. Okay. Innovation, new technologies. You're talking about ARC. That it was also we've seen the bottoms by there. And they say for the next years, I mean, coming, high nominal growth, the Fed probably will, or the central banks maybe will validate not 2%, but 3%, yet to be seen, but, whatever. And then housing is falling very rapidly, which is, we're seeing commercial real estate, where inflation is very well anchored, and also that fiscal is going to starting to get better because after COVID, all the countries are finally saying, well, enough. We need to hit that. So a lot of very good calls. It's all yours now, Jay.
Great. Well,
I'm taking notes for the next one. So
yeah, exactly. Hopefully, we'll continue to do well. But at TPW Advisory and throughout my career, I've always believed in trying to focus forward. And I think in the environment we're in and the environment we're going in, that you and I and Louise spoke about the rise of AI. And to me, one of the things that AI does is it really discounts the past and puts a premium on the future. In other words, very, very shortly, anyone will be able to call up almost anything about the past with the press of a button. And so I think huge amounts of the financial services industry, particularly on the research and strategy and sell side, is based on talking about the past. And people have been able to get away with that and make a very good living at it without ever really taking any risk. So when you think about capitalism and being rewarded for risk, I actually think that artificial intelligence is going to force a significant winnowing of the financial services world, particularly those people who have been, very comfortable talking about what already happened. And so I've always been a big believer in focusing forward and trying to be thinking about the near future and peering into the near future and having a framework to do that. And I think the framework that I've been developing over the last decade, the tripolar world, is really coming into focus. Regional integration and deepening in Asia, Europe, and the Americas, the three poles. Almost any day you want to look or read about what's happening to the supply chain in the electric vehicle space, for example, or what's happening in the semiconductor supply chain space, as an example. These are all regionally integrating. And so our process is the tripolar world, and it's served us very, very well in kind of thinking globally and holistically and trying to think forward. And you noted a number of those examples, and you touched on the high nominal growth world we've been talking about, really for almost a year now. It's been a central thesis for us. And it was really interesting to me, and not to pick on any institution versus another, but one of the very major banks in the US, a top 3 bank, just highlighted the importance of nominal growth this week. So TPW Advisory has been on it for 9 or 10 months, and your very biggest and best banks in the US are talking about it now. I think it also suggests that the opportunity and the value of an independent perspective, a truly human perspective, is going to become increasingly important in the years ahead. Again, because the machine is going to be able to do almost anything that a human will be able to do. And so having an independent point of view, having a human point of view is, I think, increasingly going to be important. And so I, in my writing, have started to incorporate much more of my own kind of personal story and personal background as an illustration of my humanity, and as a demonstration to my clients that what they are reading comes from a real person and not from a machine.
Yeah, good point.
I'm sorry?
No, interesting point. I like that.
Yeah, and I believe in this very, very strongly. I think artificial intelligence and the speed at which things are moving now and will move in the future is really almost blinding and causes confusion. And again, you have to have a process, and then you have to think about how you want to approach it as an investor. And I've been writing really since COVID. I wrote a piece in early spring, maybe early summer 2020 about COVID speed. And we followed that up with climate speed. I wrote about analytical speed. For example, the catalyst was McKinsey coming out and saying that there would be more change in the decade of the 2020s than in the last 100 years. And that was pre-AI. So that the speed angle for us is very important. And I wrote even 2 months ago, I think in January, the title of my monthly was Narrative Speed, talking about how the speed of stories is switching so fast. And again, how does one operate as an investor in that type of an environment? And you can do one of two things. You can try and ride the wave and trade around it, recognizing that you're trading against machines almost completely. And so you're most likely gonna lose. I think I said, unless you have a supercomputer in your pocket, you're probably not really very well off trying to do that. Or you can have a framework, a point of view, a vision of how things are going to unfold, and you risk that, you put bounds around the risk of that in terms of your portfolio construction, but you don't try to trade up and down with every switch of the narrative. And Luis, you were saying before we went live that, you know, less than 2 months ago, people were talking about a 6% Fed funds rate. And now we're talking about 4 rate cuts this year in the space of less than 2 months. So how are you going to actually, you know, what is your real view, and how are you going to position your portfolio around it? And it's no surprise that, you know, most and many, if not most of the major macro hedge funds have been completely blown up by that rapid shift in rate expectations. And so it's really a fascinating environment. It's one that I think actually plays to the strengths of TPW advisory. And Fabian, you were kind enough to talk about some of the good calls we had. We definitely had some bad ones too, as does everybody who swings the bat. But where I want to start off today is to go back to a couple of things. One is the what we have called the middle way, or the middle path. And again, something we first wrote about back in the summer of last year, where we talked about the path between high inflation and deep recession. And we argued that there was a middle path, and that we felt we were on it, and that we would continue to stay on it. And we continue to believe in that middle path, as we'll talk about going forward. The second kind of follow-on point is the title of our 2023 Outlook, which, in an effort to get in front of most people, we published at the end of October last year. And it was titled Return to Stability. And so I think we are in process of moving through first the COVID age. I think we're pretty much past COVID, which, as you pointed out, particularly with China moving off the zero COVID policy approach. And now we're moving past all the volatility that COVID put into the real economy. You know, supply chains are practically completely unsnarled. Inflation has started to come down materially. Energy prices, food prices, all these things are kind of stabilizing. The labor market starting to look like it's stabilizing more and more. If you look at participation rates, for example, starting to kind of link to the trend line that existed pre-COVID. And so I think this is very, very important that we're moving past the COVID age. We're moving past the age of inflation uncertainty, and we're trying to figure out what comes next. And the stock market is trying to figure out what comes next, as is the bond market, both of which have been in ranges, big ranges, but effectively range trading for a considerable period of time. And history suggests that we're getting close to the end of that range trading period. And I wrote about that in the third piece that I want to talk about, which was our latest musing now 2 weeks ago, because I didn't write last week, which was titled Firebreak. And I was making the argument there, and to kind of go back to what we talked about with AI and humanity, I talked about the idea of firebreak as a title coming to me because of a photo that my brother sent me, who was doing a controlled burn in our home state of Massachusetts. He works for the kind of like the fish and game department for the state of Massachusetts. And he was doing a controlled burn and sent some pictures. And it sparked in my mind the idea of a fire break. And so fire break means for us in the financial world, as I saw it, that the failure of Silicon Valley Bank, SVB, and the failure of Credit Suisse are a fire break, which is going to prevent the Fed from tightening too aggressively to get to inflation back down to 2%. Because SVB in particular showed that the big winners from the zero interest rate policy and the work from home policy, namely the tech sector, cannot handle rates at these levels. And so the Fed, and we've seen, as Luis touched on, that was the catalyst which sent those 6% Fed fund rate expectations down to 4 rate cuts and something like whatever, 4% or 3.75% by the end of this year from the 4.8 or so percent we're at currently. And that was purely due to the idea that banks are perhaps in trouble, and we're going to have a credit crunch, and we're going to have more unemployment faster and recession, and we've seen it bubble around for these last couple of weeks. But to us, the most important point is that basically the Fed is done, and the fire break has maybe caught, we've had a few victims of the fire, SVB and Credit Suisse and Signature Bank and a couple of others, but the vast majority of the US and global economy has been protected, right? The service segment of the US economy, the consumption segment, the employment segment, all are fine, I would argue, and therefore are protected. And I think this also kind of sets in stage the what comes next. And as we talked about again at the beginning, I'm all about what comes next, right? That's my whole approach. I want to try and figure out what comes next and position before others do, with the idea that I'm protected because I'm buying something when most people don't want it, and therefore my downside is less. And I'm protected on the upside because as people come to realize what we've been talking about for some time, they will bid me up and give me my upside. And that is really the essence of the investment approach that we take at TPW Advisory, which is a quick reminder to the folks on the call here. We offer a model portfolio delivery service with 2 model portfolios, 100% ETF focused, one being a global multi-asset model, and the second, our TPW 20, being a selection of 20 specific ETFs focused on thematics, primarily around climate, future tech, innovation, and things of this nature. So when we take that middle way, that path between inflation and recession, when we add on to it the return to stability, the moving past COVID, moving past COVID's effects on the supply chain, on labor, on price of commodities, and therefore on inflation, moving to what? What is next? And markets primarily are focused on the idea that we're going back to what existed pre-COVID, namely the low growth and low inflation world of the 2010 to 2020 period. We disagree, and we disagree pretty wholeheartedly. Our thinking is that, and you touched on it, Fabian, that we're in a high nominal growth world. And in that high nominal growth world, the Fed is not going to be able to get inflation down to 2% without really breaking the economy. And as we just touched on, Firebreak suggests that we've already reached the end of that effort by the Fed. And so we think one of the big changes, and we have 4 or 5 big changes that we're focused on that we think are coming and are actually unfolding right now, but people aren't paying attention to them because of that media and that rapidly shifting narrative that's constantly confusing people and making it very difficult to track the unfolding of these major points. But one of them is that the Fed is effectively going to change its inflation target and accept the reality of a high nominal growth world. So we expect inflation to continue to come down over the course of this year, probably end 2023 somewhere around 3.5%. We think the 3% level is going to be fine for the Fed. It's not going to trumpet that. It's probably not going to send a press release saying, oh, by the way, we've changed our target. It's important for people to understand that there's absolutely nothing sacred about the 2%. It's a purely arbitrary number. It's only been in place as a target for a decade. The Fed adopted it in 2012 because they needed a number, and that seemed reasonable. There's absolutely nothing scientific, no econometric model, nothing that says 2% is gospel. And so I do think we will move off and recognize a slightly higher inflation target that is going to be driven by the other important changes, one of which is the return of industrial policy to the United States. This is something that I think investors are completely missing the boat on at the moment. We have not really had industrial policy, and by this I mean the Infrastructure Act, the Inflation Reduction Act, the CHIPS Act, and the culmination of all 3 of those things unfolding as we roll through the rest of this decade, stimulating massive amounts of private capital alongside. Numbers like McKinsey and others are suggesting that for the roughly $1.5 to $2 trillion of public spending, industrial policy, that is going to take place, that's already been legislated, already been passed, already starting to unfold in the United States, another 2 to 4 trillion is likely to come from private capital. And since we have not had an industrial policy in the United States since the 50s, there is nobody investing, not even me, and not even Fabian with that beautiful head of white hair, and Luis as well, now that I look. Neither of those guys, and nor me, have been investing in the 50s. So the market and the investor base has no idea how to think about it, how to value it, how to position for it. And so I think the move off of the 2% totally arbitrary target, the return of industrial policy, particularly around climate and the tech sector, right? The need to have semiconductor fab plants in the US, the need to have the electric vehicle supply chain in the US or in North America. These are massive, massive things that are unfolding as we speak and completely transforming the future growth profile, in my opinion, of the world. The other parts of this are outside of the US, namely the kind of climate-driven integration process that's unfolding in Europe, coupled with the defense integration policy unfolding in Europe. You know, got no attention, but Finland just joined NATO as I think the 31st or 32nd country in NATO. So Europe is integrating in a defense capacity. It's integrating in terms of trying to wean itself off of Russian energy. It's integrating in terms of how it competes with the United States as the US seeks to become a major player in the climate mitigation business, which, as I've said for years, is the single biggest global macro theme of the decade. There is no other theme where every government in the world is spending money and will spend money for the rest of this decade. There's absolutely nothing like it. Two others that I want to mention, and then maybe I'll stop and see if that generates any questions, are the end of yield curve control in Japan. If you want confirmation that we're moving away from the low inflation, low growth world of the 2010 to 2020 period, look no further than Japan. Because Japan, which has been trying to get inflation for decades, now has 3 to 4% inflation. And the yield curve control policy, which has been designed in part to try and stimulate the economy, is now probably going to be seen as having done its job and will be shifted, I believe, by the new Bank of Japan governor, Ureda, who has just taken office. And I think that confirms, again, that's another confirmation of the high nominal growth world. Europe, just to take a step back as an illustration of this high nominal growth, Europe this year is probably going to have nominal growth of somewhere around 6 to 7%. Now, yes, the bulk of it is inflation, no doubt, not trying to argue anything other. But let's remember as investors that sales and profits and earnings are in nominal dollars. Nominal dollars. So that's what, you can talk all you want about real earnings, but that's not what the market works off of. The market works off of nominal earnings, nominal profits, nominal sales. So Europe, as an illustration, in the 3 years, 2015 to 2019, nominal growth in Europe was roughly 2%. 2, because they had no inflation. And
Wow, that's impressive.
Yeah. So then think about what Europe looks like when it's growing and what corporate earnings look like in a 6 to 8% nominal growth world. Japan had nominal growth of 1%, and it's probably going to have nominal growth this year in the 3 to 5% range. So then the last thing I want to mention, and then I'll stop. I've got plenty more to say, but I want to see if you guys have questions, and I want to take it in different directions. The last thing I'll say is China. Right? Everybody loves to talk about the Fed raising rates and the ECB raising rates. Nobody acknowledges, though, that the BOJ is not doing either, or that the PBOC of China is actually easing and providing liquidity to the world. Liquidity is fungible. And we have 4 major central banks, not 2. 2 of them are tightening, but 2 of them are easing. And the net result is a relatively decent global liquidity, not what you would think if you just focused on the Fed. And so I'm a big believer that we have a desynchronized global economy. The US and Europe are decelerating, I grant you that, but Asia is accelerating. And China, coming off zero COVID, is clearly going for growth. And virtually anytime you want to look at what people are expecting out of China, they're raising their growth forecasts, they're raising their earnings outlooks, at the same time as China's virtually only been this cheap versus the US 2 or 3 times in the last 20 years since it really developed. Alibaba, for example, sells at 9 times earnings. 9, single digit. So China is shifting from a growth profile driven by fixed asset investment and exports to a domestic demand driven profile. And that's why you credited me, Fabian, with talking about China moving off zero COVID, in August. But in December and January, when it was actually happening, people were saying they were forced into it, there were riots and they panicked. Nothing could be further from reality. This is part of a multi-pronged effort to put China on a different path. And what I mean by that is if you look at the property sector, China had been trying to clamp down on the property sector because debt had gotten out of hand. Done that for the last 3 years. Now they've removed the red lines, the famous 3 red lines for China property. And guess what? China property prices are picking up dramatically. I mean, if you want to look at the percentage gains and how real estate activity in Shanghai and Beijing year over year, it's dramatic, very dramatic. At the same time, the regulatory attack on tech has also been set aside. And the confirmation there is Jack Ma returning to China after basically spending the last year in self-imposed exile. And then third is the retirement of the wolf warrior diplomacy, where China had been acting pretty belligerently and aggressively around the world, and thus became the wolf warrior diplomacy shorthand for that kind of activity. That's been retired. China is now basically trying to position itself as the country that can bring, just succeeded in bringing Iran and Saudi Arabia together, and is about to try and bring the Ukraine and Russia together. So massive, well thought out, coordinated, organized, significant change in the second biggest economy in the world. So for us, what we're focused on at TPW is to try and assess if we are truly moving past the inflation period that came out of the COVID period. What are we moving towards? And what is the outlook for the next couple of years? And our feeling is a high nominal growth world, a global CapEx boom to deal with the issues we just talked about, levered by the return of industrial policy in the US and similarly in Europe, supported by the end of yield curve control in Japan, and supercharged by a China that is going for growth. China is likely to grow 6% this year, real, not nominal, real, with very low inflation. And that's more than double what it grew last year. So I struggle to see how folks can be bearish about the global economy when the world's second biggest economy is going to double its growth rate year over year. I'll stop there.
Super. Like always, Jay, great. And if anybody has questions, please, you can text it to us in the system, whatever. I have a few comments, and then, I'll give it to Luis. I remember we're talking about industrial policy, which we haven't seen. I remember the grandfather of a friend of mine used to sell industrial boilers in that time. And the grandma would say, oh, so-and-so worked so hard. And, his grandson and myself look at each other and say, working hard, selling industrial boilers in the 50s. He was probably taking orders. I mean, just that's all he was doing, right? And be sure that they were delivered on time, and he didn't pay his commission. But you're right. I think this is it's very interesting. We haven't had that in ages, and it will be significant. One of the things that we did some work, you mentioned this issue with defense integration. We did some work with Winston, and we couldn't find an ETF that we were comfortable, because some of them had things like Boeing, which have other business, or Raytheon, which have other business. So we did a little bit of our own, not ETF, it's a collection, because we think that it's going to be traditional defense spending. This is going to be bullets and helmets and cannons, cybersecurity, which is high tech, but a lot of that is going to be very low tech, traditional stuff that everybody now realizes that they don't even have bullets, stuff like that. So we think that, as you say, with the Finland issue, and Sweden is now on the line, this is something that will last many years. It's not just now. I mean, it's after what happened, and however it ends. I think people have learned the lesson, and all that. Climate, we see it, it's hard to see the end line, but clearly we see that there is a serious commitment on that especially from Europe. As you say, the US is a little bit more contentious here and there. But those were more comments than anything. We tend to agree pretty much in what you say. Luis, I don't know if you have any question or comment there.
I have. Jay, my first question is about China, and it's piggybacking on the things you said that specifically about the U.S. policy to onshore or nearshore a lot of the industrial capacity, industrial needs. Same is happening in Europe, and that seems to play against, at least in one way of looking at, against China, or not good for China. Despite the fact that, as you said, China is accelerating, the housing market seems to have stabilized and is showing signs of turning around, in fact. So can you please tell us a little bit more about how you see China playing that kind of a threading the needle between a West that seems to say, I want more industrial capacity here because I'm afraid of you, and your view on China, and adding that, just to make it more complicated, how you see the Ukraine-Russia putting thing into it. So basically it's a question about China, but it is expanding to these issues, nearshoring or onshoring, and Russia and Ukraine.
I have a follow-on question, but Luis is so complicated, I'll wait for the second part.
Yeah, I was going to say,
no one will remember. Okay.
I mean, there's no surprise to me, because one of the things I always loved about Luis, it was great always talking to him way back in the day at Morgan Stanley when we worked together. Always, intellectually challenging stuff. And so I think in this instance, it's the reshoring and nearshoring is, I think, starts from COVID, right? And the realization that we didn't have our own bandage capacity or drug capacity. Then you had the supply chain snarl, and people couldn't get toilet paper and all these things kind of, because we had been optimized for profitability, basically, right? The whole Western system and production system had been optimized for efficiency and profitability. And that's what gave China the leg up, because China was the cheapest place to produce. And so it piggybacked on that and became the economy that it has become. And now when we have, as you say, Fabian, a big defense policy, the military industrial complex, certainly in the United States, less so, but still viable in Europe. And, these entities need enemies. And the enemy clearly cannot be Russia, because Russia cannot defeat a country that is certainly not the United States in terms of Ukraine. So Russia has been revealed in this to be, pretty much a paper tiger militarily.
Ukraine, just interesting for the Brazilians listening, Ukraine is the size of Minas Gerais and it has the GDP of Minas Gerais.
Yeah, exactly. And Russia's not been able to subdue it after a full year of intense effort to do so. And so Russia has been revealed as a paper tiger. So you can't really say, oh, we have to spend $800 billion a year to defend ourselves against Russia. But China now looks, like it's pretty much becoming an enemy, and with its wolf warrior diplomacy, which is one of the reasons why I think they've moved off that. They realized that was counterproductive and just kind of reinforcing Western attitudes and fears, which were not positive for China's role in the world economy, as you were touching on, Luis. So I think that the first thing I'd say is that the nearshoring, reshoring, the desire to ensure that the foundational issues of the coming years, and this in a way validates kind of what we've been thinking about on the climate front, right? the desire of countries to have the full supply chain within their region. No country is going to have it all, right? That's why we never were fans of nationalism. Just look at the UK. Yeah, anytime anybody says nationalism, just say Brexit. Globalization as we knew it back when you and I were doing emerging markets at Morgan Stanley, Luis, that's done. So it's regional integration. And so when I think about the Americas, for example, as an illustration on the electric vehicle side, you have the battery makers setting up shop in Canada because Canada has all the natural resources. You have the battery makers and the EV production platforms setting up shop in the United States because we have the market. You have the EV production platforms setting up in Mexico because Mexico is right next door, is cheap, and because of the way the Inflation Reduction Act was written, any EV produced in Mexico qualifies for the $7,500 per vehicle subsidy, okay? So in the last couple of months, Tesla and BMW have both stated that they plan to produce multi-billion-dollar production platforms in Mexico. All right. So when you, as Fabian said, when you look at markets year to date, one of the best performing markets in the world is Mexico. One of the best performing currencies is Mexico. Now, this audience probably knows that, but the vast majority of people have no idea whatsoever. And it's because Mexico is probably the world's single biggest winner of this reshoring process. So when you then think about Asia and China, to your point, China is no longer really being seen as an export platform. People are involved in China to service its growing domestic demand base. And that's one of the things that China is leveraging with its effort to grow the domestic demand side of its economy. So in the US and Europe, roughly 70% of the GDP comes from consumption, right? In China, it's about 50%. So for them to move up into that kind of developed country placement, they need to shift off their fixed asset because they don't have much more stuff to build. The export, they're no longer as cheap as they were. They've become much more expensive over the last couple of years. And so the production stuff is diversifying within Asia. So this is beneficial for the Asian integration. So yes, China still has a big production base. People are still going to invest in it, but it's to service the domestic demand market in China. And you have Apple and others going to India. You have Indonesia trying to develop its own EV production process so that it's not just a raw material seller. And you're going to see a lot of integration in the Asian production process, much as you're seeing in North America, and hopefully and ideally penetrating further south into South America, given that obviously Argentina, Bolivia, Chile, Peru, these countries have much of what is needed to build the vehicles of the future. And so to me, that is, as I said earlier, that plus the desire to have the building blocks of the computing age, which is the semiconductors, right? Having them not all located in Taiwan, that's a problem. So now it's a problem for the Taiwanese. It's also a problem for the Europeans and the Americans. So now everyone is working to set up fab plants in the US, in Europe. A lot of the suppliers to the fab plants are setting up in Mexico, because guess where those plants are being set up in the US? In Texas. So right across the Rio Grande is going to be the Mexican base for for a lot of the supply stuff that goes into the semi-fab plant. And these, as you know, these are, again, multi-billion-dollar. A fab plant is a multi-billion-dollar investment. And they are now going to be in the US and in North America, in Europe, spread throughout Europe, and in Asia. And so I don't see it as inconsistent that you have that process developing at the same time as China continues to grow. Not at 10%. Those days are over for China. China is going to be a 3 to 5% real growth economy. But that's versus, the US and Europe, which potential growth rates on a real basis are, 1 to 1.5 to 2% max. Same with Japan. And that's why we need that nominal growth, because we need the nominal growth gives us a little bit more room to avoid going down into negative growth or back into the ZERP years, which when we were in ZERP, we hated it, right? Everybody wanted to get out of it. And now we're out of it, and then everybody hates where we are today. So I think that nominal growth part of it is really critical to understand why it's becoming increasingly acceptable to policymakers all around the world. And this is a debate that's been going on for years in the policy and academic circles.
All right. Good question. I'm going to quick, short answer because we got some questions.
Yeah.
But I was invited to a conference last week, and I was speaking, and someone came to me and asked me about China, right? And unfortunately, I have this answer that I've learned the hard way, that when governments that are very autocratic, it's difficult to be a minority shareholder. And I, remember my experiences with Petrobras, the government trying to control prices, YPF in Argentina, Russia, we invested, and you and I were there, remember? Yeah. So what would make you comfortable in China? Clearly, valuation is an answer, but you can also look at the valuation in Argentina, and it's very attractive, But what will make you more comfortable in terms of this? So you're dealing with an autocratic government, so they can change the tune very quickly. Yeah,
well, I think it's interesting. There was a good article in Foreign Affairs about the downside of the Biden administration's focus on dividing the world between democracies and autocrats and autocracies. And the article was making the point that the vast majority of the world falls into the latter camp, not the former camp. And so, I don't really, from my emerging market days, that kind of divide does not concern me. Really, it's what's in the price, right? What's the valuation, et cetera. I mean, the way I'm thinking about things in a very shorthand fashion is that the Fed is done. We're not going into recession in the US, and therefore the rate cuts that the market has priced in are unlikely to come to pass. But nonetheless, with the Fed being finished, the dollar is likewise finished, and the dollar will weaken as the rest of the world starts to grow faster than the United States. And that's that desynchronized global economy we touched on a little bit ago. That leads to the rest of the world outperforming the US. And I think we're in the very early stages of non-US equity outperformance versus the US equity market. And again,
Jay, sorry to stop you on this. Is this the reason why commodities could do well?
Yeah. So to prove the point, IFA outperformed the US in the first quarter, even though the US was led by big tech, which IFA has very little of. And so that really suggests the kind of the strength of this move in its early phases. So we're, when we think about our global multi-asset model, which is benchmarked 50% equity, 40% Barclays Global Ag, and 10% Goldman Sachs Commodity, we are about 65% equity. We are about 15% fixed income, and we're about 15 to 20% commodities. So we're overweight commodities, overweight equities, significantly underweight the US, overweight both DM, ex-US. We like Europe, we like Japan. We think there's a potential for the domestic investor base in both Japan and China to really give those markets a lift. If yield curve control is removed in Japan and rates start to back up, the famous Mrs. Watanabe, the retail investor in Japan, has not bought equities for ages. For ages. They've just been simply buying fixed income and riding the curve and getting paid, in real terms, a decent amount because they had no inflation. So even a 1% with minus 2% inflation is a 3% real return. So there is huge potential for the domestic investor base in Japan to buy equities. Same with China. The amount of assets that Chinese retail investors have is somewhere north of $3 to $5 trillion. They too have not really been investing in domestic equities. They've been in property. So if there's a domestic equity bull market in China, the potential for the domestic investor plus the foreign investor, foreigners are underweight both Japan and China, huge opportunity. So Europe and Japan in the DM space, and then China, Southeast Asia, Mexico, and Brazil in the EM space. We have EM local currency debt, we have Asian high yield debt, and we like in the commodity space, we like pretty much the whole complex, Luis. Obviously, precious metals, we have a pretty good sized position in gold miners. We like the copper miners as a base play on EV. If you believe in the electric vehicle revolution, then we're going to need a lot of copper. So we own PIC, P-I-C-K. And then we touched on semiconductors a little bit and AI. We established a position in the semiconductor ETFs because the semi chips are what drives AI, and AI requires massive computing power. And so if you look at SMH as an example, it's trying to break out right here as we speak. And so there are opportunities there. And then we think the energy side is also attractive. If our view, right now, the market is pricing in recession. So notwithstanding the OPEC plus news over the weekend, the speculative long positions in energy and in oil are at 5-year lows. So people are out of that. So if we're right that there's not going to be a global recession, that we're on the cusp of a new upcycle, then it's a really great opportunity to add to the energy positions, things like XLE and AMLP and OIH and things of that nature. So that's kind of our view. And we have, as I mentioned, in the thematic space, we're exposed all the way across the climate space, from EV to nuclear power to uranium to carbon. We have future tech, from cyber to fintech to robotics and automation, where we have a pretty big position in the robotics and automation in particular. And so, there to us is a lot of opportunities when we look around the world. We're pretty fully invested. We have virtually no cash. Everybody loves to talk about cash as being the place to be. But in the first quarter, cash was pretty much the absolute worst vehicle to own. Equities far outperformed cash. Bonds far outperformed cash. Commodities didn't. So in that case, cash did better than commodities. But for the most part, almost the whole global equity space did better than cash, and the whole global sovereign space and credit space, even high yield in Q1, significantly outperformed cash. And we like high yield, by the way, in the US. We don't, again, because no recession, therefore no credit crunch, and therefore fixed income, high yield is still attractive to us.
Jay, last question. So we'll try to keep it within an hour. views on hydrogen. You mentioned a lot of things, and hydrogen is one of these words that comes and goes in terms of green energy, very expensive, et cetera, et cetera.
Yeah, I'm no expert, so I can't really speak to it in any great detail. We have a position in hydrogen in our TBW 20 thematic. It's not a big position. It's more kind of a toehold type position. And I think what's important with these, with the climate stuff, is that they trade as almost like speculative things, even though there's real businesses. Hydrogen is more on the speculative side versus EV or versus carbon or versus uranium, and it trades like that. Now, the opportunity as we see it is that as we move through the COVID age, through the inflation age, and as we start to focus in on the unveiling and unfolding of the climate spending that's in the Inflation Reduction Act, $300 billion, levered with private money, the focus is going to grow on climate. So I actually think that on like a 12 to 24 month basis, climate investments, broadly speaking, should do pretty well as we return to stability and people say, okay, here, what's the next big challenge? And it's clearly going to be climate is going to be one of them. And the amount of money that's being invested, as I say, across the globe, including in hydrogen, is going to be significant. But, buyer beware, it tends to trade like a speculative entity because of, the marketplace and where it sits relative to other parts of the climate, ecosystem, let's call it.
All right. 3:27 on time. Thank you very much. Thank you, everybody. Jay, thank you. We'll have you back. It's always super enlightening.
Thank you, Jay.
And a lot of stuff to chew and think about. Thank you, everybody.
Great. Thanks, Faye.